Let me ask you a question. Have you ever opened your banking app, looked at the balance in your savings account, and felt proud? Seeing that number grow can feel incredibly satisfying. It gives you a sense of safety, a sense of control, like you're doing the responsible thing with your money. But what if that feeling of security is actually misleading? What if the money sitting quietly in your bank account isn't protecting your financial future, but slowly damaging it? Most people believe that the more cash they keep in the bank, the safer they are financially. We've been taught since childhood that saving money is the responsible thing to do. But there's a point where saving stops helping you and starts holding you back. And today, we're going to talk about exactly where that line is: the hidden problem with bank savings. To understand the problem, we need to talk about something that affects everyone, whether they realize it or not: inflation. Inflation is the silent force that constantly reduces the value of money over time. Even if your bank balance never changes, the buying power of that money slowly shrinks. Imagine putting $10,000 into a basic savings account. If that account earns very little interest, but inflation increases the cost of goods every year, your money is effectively losing value. You might still see $10,000 in your account, but that $10,000 buys less and less each year. It's like storing water in a bucket that has a tiny hole in the bottom. You might not notice the leak immediately, but over time it becomes impossible to ignore. Why inflation matters more than you think. Let's look at a simple example. If inflation averages around 2% per year, something that costs $100 today could cost $102 next year. That might not sound like much, but inflation compounds over time. In 10 years, that same item might cost $120 or more. Your money hasn't changed, but its purchasing power has declined. And if your savings account is earning almost nothing in interest, your money is effectively moving backward financially. This is one of the biggest financial misunderstandings people have. They believe that not losing money is the same as growing wealth, but those are two very different things. The illusion of safety. Keeping large amounts of cash in the bank feels safe. You can see it, you can access it instantly, and it doesn't fluctuate the way investments do. But this sense of safety can be deceptive, because while the number in your bank account stays the same, the real value of that money is slowly shrinking. And over time, this can have a massive impact on your financial future. The real purpose of a savings account. Now, this doesn't mean savings accounts are useless. In fact, they serve an extremely important purpose. They're designed to hold emergency funds, money that you can access quickly when unexpected expenses appear. Things like medical bills, car repairs, job loss, emergency travel, sudden home repairs. Financial planners typically recommend keeping 3 to 6 months of living expenses in a savings account for this purpose. Not 3 to 6 months of income, 3 to 6 months of actual expenses. That distinction matters. Understanding your emergency fund. Let's say your monthly expenses look something like this: rent or mortgage, utilities, groceries, insurance, transportation, debt payments. If those expenses total $4,000 per month, then your emergency fund should probably be between $12,000 and $24,000. That money should stay in a safe, accessible place like a savings account. But anything significantly beyond that amount may not be working efficiently for you. And that's where the problem begins for many people. The opportunity cost of cash. Every dollar sitting idle in a low-interest bank account is a dollar that isn't working for you. This concept is known as opportunity cost. Opportunity cost simply means the potential benefit you give up by choosing one option over another. For example, imagine someone has $50,000 sitting in their bank account, but they only need $20,000 for their emergency fund. That means $30,000 is essentially doing nothing. If that money stayed in a basic savings account for 10 years, it might grow slightly, but not significantly. But if that same $30,000 were invested in assets that historically grow over time, the outcome could be very different. Over a decade, that difference could amount to tens of thousands of dollars. The fear that stops people from investing. So why do so many people keep large amounts of cash in the bank instead of investing it? The answer is simple. Fear. Fear of losing money, fear of market crashes, fear of making the wrong decision. These fears are completely understandable. Financial markets do experience ups and downs. But history shows that long-term investing tends to reward patience. Markets rise, fall, and recover repeatedly over time. Meanwhile, the slow loss caused by inflation happens every single year without pause. The psychology of cash. There's also a psychological reason people prefer holding cash. Seeing a large bank balance feels comforting. It creates the illusion that everything is under control. Investments, on the other hand, fluctuate. Their value changes daily, and that uncertainty can make people uncomfortable. But comfort and financial growth are not always the same thing. Sometimes the decisions that feel safest today can quietly limit your financial progress in the future. Why banks love large savings accounts. There's another interesting dynamic at play. Banks benefit greatly when customers keep large amounts of money in low-interest accounts. They use those deposits to lend money to other customers at much higher interest rates. In other words, your money becomes a resource that helps generate profits for the bank. Meanwhile, you receive very little return in exchange. This is why understanding how money works is so important. Without that knowledge, it's easy to unintentionally make decisions that benefit institutions more than yourself. What wealthy people do differently. Many financially successful people treat cash very differently. They don't see cash as the final goal. They see it as a tool. Cash is useful for emergencies, for opportunities, for short-term needs. But long-term wealth typically comes from assets. Assets like businesses, investments, real estate, skills that increase earning potential. These assets have the potential to grow and generate income over time. Cash by itself rarely does. The mindset shift. One of the most important shifts in personal finance is moving from a saving mindset to a wealth-building mindset. Saving is important, but saving alone usually isn't enough to build long-term wealth. True financial progress often comes from learning how to make money work for you instead of simply storing it. This doesn't require complex strategies or risky speculation. Often, it begins with simple, consistent investing over long periods. Getting started slowly. For people who are new to investing, the idea of moving large amounts of money out of savings can feel intimidating, and that's okay. There's no need to rush. One approach is to move money gradually. Instead of investing everything at once, some people choose to invest smaller portions over time. This approach can help reduce anxiety and make the transition feel more manageable. The goal is not to eliminate your financial safety net. The goal is to prevent your money from sitting idle indefinitely. The long-term perspective. Building wealth is rarely about quick wins. It's about consistent decisions made over many years. Small improvements in how you manage your money can compound into significant results over time. When your money is invested wisely, it has the potential to grow alongside the broader economy, and that growth can gradually outpace inflation rather than falling behind it. Final thoughts. Saving money is a smart habit, but like many things in life, balance matters. Keeping some money in the bank provides stability and peace of mind, but keeping too much there can quietly slow down your financial progress. The key is understanding the purpose of cash. Use it for emergencies, use it for short-term needs, but allow the rest of your money to participate in opportunities that have the potential to grow. Because in the long run, true financial security often comes not from the amount of cash you hold, but from the assets and systems you build that continue working for you over time.